What does a candlestick chart actually show, and how can it help us understand market movements? Imagine each candlestick as a small story about a stock's price over a specific time period, like a snapshot of a single moment in a broader narrative. Each candlestick is made up of 4 key pieces of information: the open, the high, the low, and the close price. Let's break that down. The open is where the price starts for that time interval. Think of it as the starting point of a race. The close is where it ends, which is like the finish line. Now, the high and low points are the peaks and valleys that the price reached during that time. So, if you picture a candlestick, the body shows the distance between the open and close, while the wicks above and below illustrate those high and low points. Colors add another layer of meaning. A green or white candlestick indicates the price closed higher than it opened, suggesting a bullish sentiment. Conversely, a red or black candlestick shows the price closed lower, hinting at bearish behavior. This visual representation can help traders and investors gauge market sentiment and volatility at a glance. When you see a cluster of candlesticks that are mainly green, it might suggest a strong buying trend. On the other hand, a series of red candlesticks could indicate selling pressure. And here's the surprising part. By analyzing the patterns formed by these candlesticks, traders attempt to predict future price movements, making these charts pivotal tools in understanding market dynamics. So, a candlestick chart is much more than just colorful bars. It's a window into the market's pulse. What exactly does a single candlestick tell us? Imagine you're at a barbecue, flipping burgers. Each burger represents a price point during a specific time frame. The shape and color of the burgers hold key information about their cooking process. That's your candlestick. Now let's break it down. The candlestick has 2 main parts: the body and the wicks, or shadows. The body shows the opening and closing prices for that period. Picture it like the juiciness of your burger. The thicker the body, the more intense the price movement. If the price closes higher than it opened, the body is often filled with a color like green or white, indicating upward movement. Conversely, if the price closes lower, you might see a red or black body, reflecting a decline. But here's the surprising part. It's not just the body that matters. The wicks, or the lines sticking out from the body, represent the highest and lowest prices reached during that time. Think of the wicks as the grill marks on your burger, the highs and lows of the cooking process. A long wick on the top means prices reached a peak before falling back down, while a long bottom wick indicates a significant low that buyers pushed up from. So, when you look at a candlestick, you're seeing much more than just a price. You're observing the story of that period's trading activity, who was buying, who was selling, and how the market was reacting in real time. By understanding these elements, you're already getting a clearer picture of market dynamics. Ready to dive deeper? How does the time frame of a candlestick chart change what you see? Imagine you're looking at a photo album of a friend's vacation. If you only flip through a few snapshots, you might think it was a sunny trip full of beach days. But if you see a series of weekly photos, you'll notice it also rained and there were some cloudy moments. The difference in perspective is all about how long each moment captures. In trading, the time frame works similarly. Candlestick charts can be displayed in intervals ranging from 1 minute to several months. Each interval tells a different story about market activity. For example, a 1-minute candlestick shows rapid price movements and can give day traders insights into short-term fluctuations. It's like zooming in on those beach photos, capturing every wave and flip-flop moment. On the other hand, a daily or weekly candlestick paints a much broader picture. It smooths out the noise of daily ups and downs, allowing you to see the general trend over time. You can identify whether the market is generally bullish, where prices are rising, or bearish, where they're falling. Think of it as looking at the entire vacation from a distance, where you can appreciate the overall experience without getting bogged down by every single detail. But here's the surprising part. Choosing the right time frame is crucial. If you're day trading, a shorter time frame is vital for capturing quick moves. If you're investing for the long haul, focusing on longer intervals can help you avoid getting rattled by daily market swings. Each time frame reveals different dynamics in a market, and understanding this helps you make more informed decisions. So, the time frame matters because it alters how you interpret the candlesticks. Whether you're zooming in on the details or stepping back for a broader view, each choice shapes your understanding of market trends. Next time you look at a candlestick chart, remember, the time frame is your lens. What do candlestick patterns really tell us about potential market movements? When you zoom in on a series of candlesticks, you can begin to see patterns emerge, like the hammer, engulfing, or doji. Each of these patterns has its own story to tell about the buying and selling activity during that time frame. Take the hammer, for example. Picture a hammer striking down. The body of the candle is small, but it has a long lower shadow. This suggests that sellers pushed the price down initially, but buyers stepped in to drive it back up, showing potential strength. It's like a tennis match where the ball is hit back over the net just before it hits the ground. Then there's the engulfing pattern. Imagine two candles. The first is small, and the second completely engulfs it, both in body size and color. This can signal a shift in control from sellers to buyers, or vice versa. It's a visual cue that a trend might be reversing. And let's not forget the doji. A doji candle has a very small body, indicating indecision in the market. It's like a seesaw, teetering back and forth without making a clear decision on which side to fall. But here's the key part. While these patterns are intriguing and can provide valuable insights, they're not foolproof. Relying solely on them may lead to mistakes. Instead, think of candlestick patterns as part of a bigger puzzle. When combined with other forms of analysis, like trend lines or support and resistance levels, they can enhance your understanding of market dynamics. So, when you examine these patterns closely, they become more than mere shapes on a chart. They transform into indicators of market sentiment and potential future movements. Understanding this interplay is crucial for making sense of the markets. So, what does a candlestick chart actually show? At first glance, it may look like a jumble of colorful shapes, but each candlestick is a chapter in a much larger story about price movements over time. Imagine you're watching a sports match. Each play, each score, tells you something about the teams battling it out on the field. Similarly, each candlestick represents a showdown between buyers and sellers. Let's break this down. Each candlestick has four key components: the opening price, the closing price, the high, and the low. Picture this like a boxing match. The opening price is where the fight begins. Let's say it's the first bell ringing. The closing price? That's when the fight ends. The high and low represent the highest and lowest punches thrown during that round. When you look at a series of these candlesticks over time, you're not just seeing isolated events. You're witnessing the ebb and flow of market sentiment. For example, if you see a series of green candlesticks, it's like a winning streak for the buyers. The energy is in their favor. Conversely, red candlesticks signal that sellers are gaining ground, pushing the price down. And here's the surprising part. By analyzing the shapes and sequences of these candlesticks, you can glean insights into potential future movements. Patterns like doji or hammer can indicate indecision or a potential reversal, giving you a deeper understanding of market dynamics. So, to sum it up, a candlestick chart reveals the ongoing battle of buyers versus sellers, unfolding over time. By reading these battles, we can gain valuable insights into market psychology and make more informed decisions. If you found this explanation helpful, consider subscribing for more insights into how the markets work. So, what have we uncovered about candlestick charts? Instead of just being colorful blocks on a screen, each candlestick is a storyteller, revealing the dynamics of buying and selling during a specific time period. Each one captures the open, high, low, and close prices, allowing you to see not just where the market has been, but also where it might be headed based on past behavior. Now that you have a grasp on how to read these charts, you can start applying this knowledge to your own market analysis. Imagine you're looking at a daily candlestick chart of a stock. As you identify patterns like bullish engulfing or doji candles, you'll begin to understand the psychology behind price movements. It's about getting a feel for the market's mood and sentiment, almost like learning to decipher a new language. And here's the surprising part. The more you practice reading these charts, the better you will become at recognizing trends and potential reversals. You won't just be looking at numbers. You'll be interpreting a visual representation of market emotions, trading strategies, and even broader economic indicators. If you want to delve deeper into how to read charts and understand market movements, you're in the right place. We have a wealth of educational content waiting for you. So, If you found this exploration of candlestick charts enlightening, make sure to subscribe and keep expanding your market knowledge. You'll never look at a chart the same way again.